Thank you so much, gentlemen, for staying with me. Thank you for your time so far. Let's quickly pick this up. I'd like to get your reactions. Of course, as you heard earlier from the governor, the MPC unanimously voted to keep the MPR at 11.5%, along with the asymmetric corridor of plus 100 basis points and minus 700 basis points. All other parameters held steady. Now, according to the CBN governor, tightening would negate the desire to expand credit to the real sector. Loosening will trigger excess liquidity and worsen inflationary pressures, and holding, he said, is more beneficial as it will allow current policy measures to, paraphrasing him now, to bear more fruit. Bismarck, let me start with you. What is your reaction? Did anything else stick out for you from the MPC's announcement?
No, deja vu. We didn't expect anything else, and they just did exactly. But what was interesting was that he omitted the fact that inflation was also as a result of an exchange rate pass-through effect. Mm-hmm. So two things come out there. One is that the exchange rate depreciation has helped to stoke inflation. Two, the fact that availability of forex in the official market, in other words, the rationing of forex, has also has also led to scarcity, which was reflected in high prices. And also very optimistic about the fact that inflation will moderate in the first quarter of 2021 because of the harvest. I do not think so. I think that the impact of the pass-through effect of exchange rate scarcity on one hand, the pass-through effect of will also hold inflation. So we see inflation getting as high as 16%, and that will force a situation where interest rate trajectory will have to be changed, at least at the next meeting. That's what I think.
Nnamdi, can we hear your reaction, please?
I think basically in line with a lot of what Mr. Rewane said, because first of all, most of us didn't expect any form of action whatsoever from the MPC. Secondly, it was instructive to note that he totally seemed to ignore the FX pressure that we're seeing, almost as if the parallel market rates, which seem to have gotten to 480, 490 levels, more or less non-existent. No measures talked about how they're going to try and stem the pressures that they're seeing in that particular market. For the inflation, he talked about everything from structural issues to logistics to power to supply chain issues to COVID. And like Mr. Rewane said, absolutely didn't mention currency, which seemed pretty odd to me. I'd have expected that they would have also acknowledged the fact that currency was a big issue. From what they've said, it's obvious that growth is where they're still looking at. They believe that inflation would more or less stem by Q1. I mean, time will tell, but also points to the fact that they don't really intend to combat or focus on inflation or focus on currency in the near term. So based on that, it means that the next MPC meeting that they have, we most probably won't see them talking about inflation or talking about currency, at least from the feelers that I'm getting from what he has said today.
Now, Gregory, ahead of this MPC meeting, you did put out a note, and in that note, you did mention that it was very unlikely that the CBN was going to mention or focus, that's the MPC now, focus on FX, and it looks like that is what has happened. Could you speak to that point, and also what were the key takeaways for you from the MPC announcement?
Yes, thanks, Esther. Yeah, I know we did say that MPC is unlikely to dwell too much on FX. We're not saying that's right or wrong. We're just saying that's precedent. This is a CBN matter. Of course, we know there's a big overlap between MPC membership and senior posts at the CBN. But that's a norm, if you like, for MPC. Not saying much about it. We'll see a little, of course, when we see the personal statements eventually, but even then, not very much. Other takeaways from well, I agree with my colleagues, of course, largely. But just one, two things. So the governor trumpeted the success of two policies. One, of course, is hiking the loans deposit minimum, and he produced some data. And the second one, of course, is the central bank's own credit interventions, which there are going to be more of them. And he said in the Q&A, you could hear what's going to happen is these are going to multiply. We're not going to talk about the CBN's balance sheet, but we are going to talk about the fact that a multiplication of interventions. And he mentioned specifically targeted credit. Just pick up two very small points from his commentary. One, or the communique, let's say. One is that, the DNBs are lending at lower rates, is what we are told there. I'm not quite sure how much lower. And the second point is the equities recovery. Well, yes, but of course, it's very impressive. You know, down 30% year to date at one point within the same year, now up almost 30%. So a huge swing. But, you know, normally people invest in equities because they like the growth story or the domestic consumption story. Here, really, it's more a matter of asset allocation.
Bismarck, let's focus now on what the governor said in terms of how the fiscal authorities, in partnership with the monetary authorities, are going to help aid this recovery and get this economy back off the ground. He did mention that the CBN development finance rules will continue and that the CBN would engage the private sector. He also mentioned that the CBN, the current schemes in agriculture, the low interest loans schemes will continue. But what are your thoughts in terms of this approach? Of course, he did mention that, of course, having a vaccine thrown into the mix would be good for the economy as well. But what do you think about this approach to aiding a recovery?
I strongly believe in evidence-based analysis. If you look at what he announced, he said 19.35 trillion was the total credit exposure, and it has grown marginally to 19.54 trillion in the last 3 months. In other words, the total loan volume, total aggregate credit has hardly moved in the last 3 months, in spite of all of the interventions. 1. 2, 19 trillion as a percentage of total GDP of 155 trillion. It's not going to move the needle. It's not going to have an impact, significant impact on GDP and output growth. So it's directionally, it's okay, right? Nominally, it's okay, but in terms of impact, it's not going to change the outcome. So I think that's a very important point. Secondly, the coordination between fiscal and monetary policy to achieve what you want to accomplish, what the objectives are, is quite interesting. But I think both the fiscal authorities, and I listened to the Minister of Finance yesterday, and the monetary authorities are overly optimistic about the outcomes. I think that, yes, we will recover in 2021, but it is extremely optimistic to think that by next month, and don't forget, this is the quarter in which you had the answers, that by next month, this whole recession will be over. We will quickly get into positive growth and stay that way. I think that it's going to take slightly longer, even though the base year effects begin to wane, because by this time last year, COVID had already started. COVID had started in China by this time last year, but the lockdown in Nigeria was only in March. So when you now compare Q4 last year with Q4 this year, when the slowdown has started, and Q1 2021 with Q1 2020, we begin to see slow signs of a recovery, but it's going to take much longer. So yes, coordination works. Yes, it's good. But I don't think that you have the desired impact.
Nnamdi, let me bring you in here. Bismarck. Okay, hold that thought for us, Bismarck.
Yes.
Nnamdi, let me bring you in here. What is your take on our approach to growth going forward? Bismarck says that the fiscal and monetary authorities are overly optimistic.
Well, I believe, yes, that they're optimistic, but I think that's a big chunk of the work will land squarely on the hands of the fiscal side. I think the monetary policy side is almost at its end. If you consider the fact that 1 year T-bills closing at 0.3%, and we're talking about Fed fund rates here applying to local instruments. You see the local euro bonds trading at lower levels than, the local domestic bonds trading at lower levels than even our euro bonds, right? And you see 3-4 year bonds trading at about 3%. It says to you that there's not really much else you can do from a monetary policy standpoint. You have NIBOR, 90 days NIBOR trading at about 1.5% or thereabout. Where else do you want to push rates to? So definitely you're going to need to have the fiscal side sort things out. During the session that they had yesterday at the NESG, they talked about fiscal prudence, fiscal policy authorities basically sorting out their own side of things. And I think that's going to be extremely key and extremely important for us to be able to get the economy back on track. And yes, it's a bit optimistic to expect everything disappears by next month. But I mean, we need to see what action that they take and see what budget gets approved to see how things will really pan out starting from next year.
Gregory, we have just 2.5 minutes left. Let's hear your thoughts on our approach to growth. So Nnamdi says the fiscal authorities obviously have the bulk of the work to do. In terms of priority or how they can, boost growth significantly, what do you recommend?
Well, it's a small, the fiscal stimulus is small. I think Bismarck earlier gave the figure for government spending as a percentage of GDP. It's very low, and therefore the impact, the stimulus is reduced as a result. But still, even within the reduced stimulus, there's some possibilities open. For example, well, everyone says, of course, you should be spending more capital spending. But what happens is that if you produce, this is a mark actually, this administration, you produce over-optimistic revenue projections. Invariably, you can't attain them because they're very optimistic. Therefore, you trim spending. What spending do you trim? You trim capital spending because you're obviously going to pay people's salaries and you're going to pay your creditors. But there is some, we're looking for some positives, some light at the end of the tunnel, if you like. And on paying the creditors side, I mean, I think the figure in this year's budget for debt service, 2.6 trillion, 6.8 trillion, I think the figure was. That's excluding sinking fund. So, we are seeing, the cost of issuing debt is much reduced now. So maybe there's some prospect there. But overall, you have to have more efficient allocation of public resources. So, you need to get your revenue in. Of course, there's no tax increases, nor should there be. But the issue is not really the tax rate. The issue is tax coverage, i.e. who is paying tax, who should be and isn't paying tax, basically. And are you raising it in the right from the right sources? I mean, there's 7%, I think, what revenue last year, 7% of GDP. It's pitifully low. Should be 20. Kenya, I think, is 18%.
I think we have just about 1 minute left. Let me see if I can get a comment out of Bismarck. Bismarck, obviously, getting FDI in the new year will be key for the government. What are your thoughts on what we're doing to get more FDI in?
FDI will come as a result of improvement in confidence.
Keep it short, please. Yeah.
Yes. FDI will increase if confidence level increases. Confidence level increase if you have a proper exchange rate management mechanism in place.
All right, we'll keep it there. Thank you so much, Bismarck, for your time. And of course, a big thank you also to Nnamdi Nwizu, co-managing partner at Comercio Partners, and Gregory Kronsten. He's the head of macro and fixed income research at FBNQuest.